This episode is sponsored by our friends at Ycharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. Ycharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, Ycharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them towards informed decision? Ycharts has tools for scenario building, portfolio construction, and proposal generation that can be the missing piece to your service, so you can act on an idea right when the light bulb flicks on. Again, I mentioned this last week, but there's a reason almost every post I do at the start of most of these at the start of most of these podcasts, if you watch on YouTube, there's a reason I use Ycharts graphs for them. And it's because they're really simple, they're really easy, and they look great. I can't spend, if I'm using some other service, I can't spend 30 minutes, an hour and a half trying to get 4 different charts ready for a post, right? Like that would take almost as much time as the post of the podcast I'm actually taping. Ycharts is simple, it's easy, the charts look great. So if you're interested, click the link in the show notes to start your Ycharts free trial and see how Ycharts is a one-stop shop for growing your business with few hours spent. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm not sure if it's the 4th or 5th time, but I'm happy to have him back on, my friend Bill Chen. Bill, how's it going?
Yeah. Hey, man, I think this is the 5th time, but, glad to be back on a podcast. And, everyone's gunning for Jeremy Raper's record, right?
Yeah. Well, number one, you're not wearing the hat. And I thought we sent you the shirt. I can't remember. If not, we'll get it sent to you, but not wearing the hat or the shirt. That's upsetting. But we've got a lot to talk about today. Before we get there, just want to start this podcast off with a reminder to everyone, nothing on this podcast is financial advice. That's always true. I'll say particularly true today. I say that on half the podcast, but Bill and I are going to start with an overview of a little bit of publicly traded real estate, and then we're going to dive specifically into one name. But because we're starting with an overview of, just the general overall sector, that might apply extra. So please consult a financial advisor, do your own work. By the way, Bill, we have a specific single stock name that we want to talk about. That's the reason you kind of reached out and wanted to come on the podcast. But before we go there, I wanted to follow up. You came on, I believe, last October-ish. You came on this podcast. Mm-hmm. You went on a few other podcasts, and you said, hey, now is the time. Publicly traded real estate is trading at huge discounts to privately traded real estate. It's trading at a huge discount to replacement costs, like however you want to do it. This is a once-in-a-generation opportunity, and you even shared some slides and everything. And look, hindsight's 20/20, but in this case, you kind of were right? Like you can go look at publicly traded real estate. It's done really well over the past, let's just call it 12 months to make the time frame easy. So first, kudos to you. I've sent you some clips of drafts that I've never quite said, but I've said like, it's just so cool to see you, my friend Hawkins, a few others who were just so publicly saying like, this cannot last. These are too cheap. But now that I've thrown the flowers on you, I want to just pull back and ask, hey, we're 12 months into this call. If they've had a good run, where do you think we are now kind of in the capital cycle of publicly traded real estate versus privately traded, the opportunity set and everything?
Sure. I mean, I think we're still holding on to a lot of large cap multifamily REITs. And I think a lot of it is that if you look at a few of the big transactions that got done this year, if you look at what Blackstone pay, what KKR pay, what an EQR, a public traded REIT actually bought some about multifamilies. If you look at all the cap rates that they paid, they were consistently caught like it, all in the 5 handle, right? And like low 5, mostly low to mid 5s, right? Is what they've been paid. And then the Blackstone deal is a little bit unique because you kind of have to like tax and insurance adjust it. So like I've seen estimates from anywhere from 5.2 to 5.6, and that was a deal that was probably done a little bit earlier when there was more uncertainty around multifamily. And now we're starting to see deals. The KKR deal, everyone thought that was done at a 5% cap rate. But then on their calls, they said that on a day one yield with a 4 handle, like people are kind of trying to figure out, like, are you really saying you bought these assets from Lennar at, in a 4% cap rate range? Like, there's still a lot of chatters, like, they haven't come out outright said, it's a 4% cap rate. a 4% yield, right? So I think that if you look at a lot of the big the public REITs in our portfolio, they're still kind of trading in that high 5% cap rate. They got great balance sheets. You know, they got the best access to capital out there. Earlier this year, Mid-America and Camden issue 10-year unsecured bonds at 4.9 and 5% interest rate, and they could probably get access to that at even lower rates today. So I think that we could in our model, like, we probably don't want to be sellers until these large cap multifamily REITs reach to at least like a 5%. I mean, like, we've been very consistent in saying that, right? We've been very consistent in saying, even though we got a lot of pushback from people were saying, well, you know, the 10-year yield is 4.7. You should put, like, you know, blah blah blah, like cap rate, you know, a spread on it. But like, I think based on replacement costs, based on the fact that a lot of supply has fallen off in the market, you know, there's just no new construction starts, that the market is now starting to kind of buy into what we've been saying for a really long time, which is this environment is not conducive to new starts. So the market, when I'm starting to hear the narrative that, oh, you know, guess what? Like late 25 to 28 is got to be a great period where you're not going to have a lot of competing supply, right? You probably raise rents by, you know, 4 or 5% a year, and that's, you know, in a potentially low rate environment, that's a great setup, right? So we probably don't want to be sellers until you know, the cap rates trade down to a 5% cap rate, and I, you know, there is a scenario, and in recent years, like, the publics tend to trade at a discount to private, but, you know, with everything that's going on, people are kind of starting to see, hey, you know, if you're in the private, you get potentially lock up with you know, the B REIT, the S REITs, you know, you get limited liquidity, right? And the implied cap rate is still in the 4s. So, and then you got the public, it's liquid, it's at a higher cap rate. Like it may actually, there's a scenario where the publics could potentially trade at a premium to private, like it's happened in the past. I know, like, when we last did the podcast, no one thought, like, everyone thought, like, you know, like, you'd be crazy to suggest something like that. But
you said it.
You know,
Hawkins is the other one who he came and he was pounding the table on Vernado, and he was like, look, everybody says, oh, publics trade for discounts to privates. Go back 20 years and publics traded for a huge premium to privates. And that, you and him saying that are the two that kind of like reshifted, like, hey, we might be a little bit victims to the moment here, because public probably should trade at a premium to private, to be honest with you.
Yeah, and we kind of spent a lot of time, like, writing this to in one of our letters that's about to come out, and we wrote a lot about the REIT mafia dynamic, right? Like, there's this dynamic where, hey, if you got headwind at the moment, well, you know, the REIT mafia investors don't want to own these companies, right? And that's how you wind up with an opportunity to buy large cap multifamily at a 7% cap rate. You know, it was like roughly that type of valuation when you and I were talking. And I'm like, these are actually some of the most sound, the most, you know, got the best, most pristine balance sheet, and yet you could buy them at a 7% cap rate. Like it was the most obvious. It is one of the most obvious investments in my career. And we're not, you know, we're not looking to sell. Like, we're not looking, like if we have to trim some of it, it's probably because we found something that's a 3-bagger over 3 years, and like we'll like begrudgingly like trim some of those positions to fund something else.
Can I quickly ask you? So a few times you said we're not looking to sell, we're waiting until these hit. I'm just going to choose a 5 cap rate. It's kind of a target. Obviously, a lot more goes into that, right? Like a 5 cap rate on office versus the best apartment building in a great market, right? A lot goes into it, but let's just use your 5 cap rate. You ask. I just want to, you know, how does that 5 cap rate interplay with the Treasury rate, right? Is that a 5 cap rate, kind of assuming the Treasury, let's use the 10-year Treasury kind of at 4-ish. It's kind of around here. Like, if the 10-year Treasury dropped to a 2, should all of us, you know, kind of back like what everyone did in 2021, should all of us pull that 5 cap rate down to a 3 cap rate? Or does the 10 rate drop to a 2 because, you know, inflation, there's no inflation expectation, so that 5 cap rate, like, should stay a 5 cap rate because you're not really protecting inflation? Or conversely, if the 10-year goes up to a 10, should we take that 5 cap rate and change it to a 12 cap rate? Or should we keep it at a 5 cap rate because it's at a 10 because inflation is going crazy and we're going to get a pass through all that and our replacement cost goes way up? So how do you think about the interpol of like just the 10-year versus that cap rate you're assigning?
Yeah, no, I mean, I think the 10-year is very, very important, right? And I would say not just
I mean,
10-year, but also
let's assign the most obvious thing, the gravitational pull of all finance, right?
Yeah, I mean, the most important benchmark in all finance, right? I would say that if the 10-year is stuck at 4, say like a year from now, the 10-year is at 4%, in that scenario, a 5% cap rate, probably like we may be sellers if we could find other things that are more interesting, right? If the 10-year does go down to 2.5%, at a 5, that's a really nice 250 basis point, right? And then like you kind of got this. Also keep in mind, like a lot of the reason why the opportunity was possible in the Sunbelt multifamily was because there was this very large delivery, which like has been absorbed very, very well by the market, right? Everyone thought that rent was going to collapse, and then both Camden and Mid-America have come out and guided. Mid-America, I think, is guiding to like down 1% NOI for 24, and then Camden, I believe, if I remember correctly, is actually like up 0.5% or 1%. It's like if you take a 7 cap and to get to a 5 cap, like you need NOI to collapse by over 20%, right? And clearly that's not happening. So, but then like I bring this up because in 25, like now you have a 5 cap, but like you could look out 2-3 years and you're probably going to comp same store NOI by, I don't know, I'm pulling numbers out of my thin there, like 3 to 6%, like depending on each local geography, supply demand dynamic, right? Like I would say that if you have very little supply delivery and we're not in a bad recession, like you could probably count on at least like 3% same store NOI growth, and I think that sets us up really, really well at a 5% cap rate with that kind of growth. I think what it would do is make it very attractive to a very large pool of capital where the alternative is 2.5% in a 10-year Treasury, right? And then you could buy, this kind of pristine, diversified, large cap, super liquid, multifamily REITs that you could do the simple math, right? Do I get 2.5% in the 10-year Treasury with no inflation protection, or like, at a 5 cap, you're still getting like a 3% dividend yield, but you're getting like somewhere between 3 and 6% rent growth because of that very unique supply dynamic, right? Like it kind of in that scenario, it becomes like a bit of a no-brainer to go choose the multifamily REITs. So we'll course adjust depending on interest rates, and the 10-year is the biggest input to every asset pricing, which is why we track it very, very closely. So that's kind of how we're thinking. Yeah.
It completely makes sense. One more question. Look, last October, you were really banging the drum. These stocks have done really well since last October. Pick your, I just pulled up on Ycharts, Mid-America, MAA, because that's like a giant apartment and super, super liquid. Up about, since we did the podcast, I think it's up, total return is over 25%. So, there aren't too many people who looked at over 25% total return inside of a year. That's a really nice thing. I want to ask you, look,
don't forget the dividends.
This was total return, so it did include the dividends, and it very much depends on the day, because last October people forget it was down 5%, up 6%. Like, it was really crazy, but it's about. There are a lot of these guys, right? Some of them sold to Blackstone, as you mentioned. There was a big KKR deal, but I just want to, on the whole, when you look at a lot of the stocks we talked about, how much of their performance, or how would you grade them as managers, right? Like the stocks have done well, but do you think they've done well almost I'm not calling any specific one out, but do you think they've done well in spite of the management teams? Do you think a lot of these management teams, like kind of, they don't have to cover themselves in glory, but do you think a lot of the management teams enhance value? Because I'm just curious, like how you've got a big position, you've taken a big stake, and management matters for that, unless you're trading it as like kind of a sardine. So how do you think these management teams have dealt in this environment?
So I think like particularly the two Sunbelt, which is Mid-America and Camden, I think they essentially have kind of stay within the box mandated by REIT mafia, right? Like they have very specific, this is what we're going to do in terms of leverage. This is how we're going to ladder our debt maturity. This is how, they just kind of like, it's almost like sometimes I hear people talk about like the democratization of like real estate ownership, and I'm like, that solution is solved like 50 years ago, right? Like, especially those two large cap REITs, like they have played very specifically within this like unwritten protocol. They kind of have an unwritten agreement with the shareholder base that the loan to value is going to be around 20%. You know, they could take that up to maybe 30, right? The ladder maturity, like, you know, how do you allocate capital? Is it okay? Like, you could go buy something at a 5.5% cap rate. Well, we could buy back shares at 7, which is what Camden did in the first quarter, right? So like there's this like very kind of, and we understood that going in, right? We understood that this is like not some sort of family control with like their own agenda. This has a very robust, very widely distributed shareholder base, and the REIT mafia is like basically instill, this is what you're going to do. You're going to stay within this leverage ratio. This is how you're going to allocate capital. If you think you're trading at a premium, like issue shares, go do deals, right? If you're trading at a discount, like go buy back shares or go do some distressed acquisitions, right? And I think that those two REITs that I mentioned have like followed those instructions like kind of to a T, right? Which is why like we size them to be the biggest, because when the sentiments change, we found in our experience that you kind of don't want to be allocated to like a smaller cap that's like under the radar, because the capital, the flow is going to go back to the larger guys. And those are like the subtle little nuances that we pick up from being a public equity investor for like over a decade.
No, I'm just laughing because last year I got really into banks for a while, and I go find these banks that were super illiquid, and the stock was, the banks index was down 50% and their stock was down 70%. And I was like, oh, this is an opportunity, like better balance sheet. I think the management team's great. And guess what? A year later, the bank index is like kind of back to where it was, and these stocks are still down like 40% or something. It's like, gosh darn it, I could have got more liquidity, easier, less, just, so I'm laughing there. And I just wanted to your point on follow the box. Yes, it's keeping it simple, and you're not going to generate, this generated 25% off the bottom, but the company as a whole is not going to compound capital at 25% for 5-10 years following the stocks. But look, 5 years ago, I would have looked at them saying like, this is our model. We keep leverage low. We keep it simple. If we're at a premium, we issue shares. If we're at a discount, we'll buy back a little bit of shares. But we kind of keep it simple. 10 years ago, I would have looked at that as it's silly. But today, I'm like, look, these guys can raise unlimited sums of capital over the long term. Investors can sleep at night. They're going to be here. Okay, cool. They're not going to be the next Berkshire Hathaway, but guess what? They probably deliver over the long run index-like, maybe a little bit better than index returns. And the management team's going to get paid really well. Shareholders are going to sleep at night. It's not a bad strategy. So
I mean, if you there's narrative of passive income. Right, like people talk a lot about passive income, and you want to truly just outsource it. You want a stream of cash flow that is coming in. Like, what's better than having 100,000 units owned by Mid-America, diversified across a dozen Sunbelt cities, right? And you have hundreds of buildings, so like no tornado, no sinkhole, if you allocate to a single deal, right? Literally, like the Greenblatt, Joe Greenblatt has a famous story where a building literally fell into a sinkhole in Florida, and then like all his equity in that deal is wiped out, right? Like when you think about these, those REITs with like that kind of market diversification, building diversification, unit diversification, you start to really get like blend, you really start to blend the exposure. And you're exactly right. Like they're paying out 2/3 of the cash that's available for distribution. You're clipping that, and there's 1/3 of it being reinvested into the business, either via like value add projects internally, acquisitions, buybacks, etc., whatever it may be. It's like the ultimate, just kind of, hey, like you buy it, you're not gonna have one of those Jeremy Raper like crazy multi-bagger, but like I think you also chop off a lot of the left tail, right? Like you chop off a lot of the left tail, you kind of shrink your right tail and your left tail, and then you're kind of in this box. And also Mid-America, we looked at their long-term track record. I mean, they've done better. Like if you use S&P as like a 10%, since going back to the 1920s, Mid-American actually has CAGR, I believe, like depending on when the time period is, the past 20 years is actually 12%. I mean, so like higher than what a typical S&P is. So it's more like, it's pretty impressive. And then if you have a company that CAGR, call it 12% over 20 years, and then you're able to buy it when the stock falls off 45%. I mean, that was kind of a pretty, obvious signal that hey, it's worth taking a look into.
I had one more question for you. Yeah. So over the weekend, and I know you listened to some of the podcasts, probably not all of them, so no problem if you didn't listen to it, but I did one of my rambling podcasts. And one of the things I talked about was due diligence trip, because I went on this great due diligence trip and, I doing the boots on the ground. And as I was doing it, and I was thinking about some other investments that other people have made that I don't want to talk about, but as I was doing it, I was like, look, I'm having a great time. This casino is lovely. The whole place is lovely. This is great. Yeah. But I am worried, like, look, they put... Monarch Casino was one of the ones I was visiting. It's been a huge success. But, if I had visited when they built, I would have said, hey, they put $500 million into a casino like an hour outside of Denver, like way out in the mountains. It's literally a one-lane road driving in there. The town, like it was like a 50-person town, old mining town. I would have really worried. Yes, I love it here. It's beautiful, but $500 million is a lot of money. Can they get that return? Yeah. Every time you and I talk about investment, you send me a photo of you, in a hard hat. I just wanted to ask you, when you're doing these due diligence projects, and we've talked about a lot of them, how do you separate, hey, this is great, but they might have spent Ritz-Carlton money, as I like to say, when it deserved, kind of Motel 6 style returns, or they spent Ritz-Carlton and they built it, out in the middle of nowhere, no one's ever going to come. So it's great. It's fun to diligence, but it's never, how do you kind of think about that when you're putting boots on the ground? I just wanted to ask you that one.
Yeah, I mean, I think so. So if we break down the nature of my due diligence trips, a lot of times it is, I want to make sure I don't take my New York City kind of mindset and look at something and say, ooh, like that really nice apartment only costs $2,000 in rent, right? Like that's super affordable, right? And then like,
you go to New York City and you visit anyone else and you're like, oh my God, like I have a shoebox and I pay twice your mortgage. It can be really wild. Yeah.
No, exactly. And that's where I think, so like the Monarch example is kind of one extreme, right? Like one analogy to that would be like the Seaport by Howard Hughes, right? So maybe we'll get into that today.
That's actually one I was very much thinking of when I was thinking of that.
Okay.
But, you go read about people talking about the tin building and how much money they put, but let's not have that specific one.
That could be a separate conversation on its own. But like, I think on the due diligence trips, a lot of times what we're trying to do is we're trying to, when you look at real estate, there's the actual building, the asset itself, and then there's a land and area component, a neighborhood component, right? And the neighborhood component is almost, I would say, if not more important than the building itself, because, Miami was a market where I kept hearing about, hey, it's great. Like all these finance firms, all these tech firms are moving down there. And in my head, I'm thinking Miami from 20 years ago when I went on a cruise with, three of my best friends, and it was just kind of a party town back then, right? Like, so like, obviously my views on Miami are dated. It's no longer relevant. So we made a conscious decision to spend a week. I was there for maybe like 3-4 days. My analysts stayed around for the whole week. And we're very kind of dogmatic and proud of the fact that we use a lot of data. We look at a lot of data, but at the same time, like nothing beats putting boots on the ground. And I'm the kind of guy, if I'm putting boots on the ground, I'm paying attention to, okay, are there young people here? Are there attractive people? Like we place a really big premium on saying you work in finance, you work in tech, you work in some sort of highly compensated field, right? What is your dating prospect, right? Like that is one of the most important questions that you have to ask, right? Because if it's hard to date for a young single, call it 22 to 35, right? Like the area just naturally is going to have difficult attracting talent, right? Attracting really good employees. So there's a lot of little qualitative subtleties and JBG Smith is a company in Crystal City, right? We've been down there 4 different times. And you could make an argument that Amazon headquarters, we put boots on the ground. We're just like, this kind of felt like John McCain used to live here and never left, right? Now it's slowly transforming, but we could kind of, there are areas and neighborhoods in Brooklyn, right, that are just so vibey, that we feel really, really comfortable. And there are other areas that I've been to where I'm like, I get it. I get why the youngsters want to be here. And I get why, if you're Citadel or if you are, Goldman Sachs, why you want an office here. And those are really, really key criteria that we pay a lot of attention to.
This episode is sponsored by our friends at Ycharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. Ycharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, Ycharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them towards informed decision? Ycharts has tools for scenario building, portfolio construction, and proposal generation that can be the missing piece to your service, so you can act on an idea right when the light bulb clicks on. Again, I mentioned this last week, but there's a reason almost every post I do at the start of most of these at the start of most of these podcasts, if you watch on YouTube, there's a reason I use Ycharts graphs for them. And it's because they're really simple, they're really easy, and they look great. I can't spend, if I'm using some other service, I can't spend 30 minutes, an hour and a half trying to get 4 different charts ready for a post, right? Like that would take almost as much time as the post of the podcast I'm actually taping. Ycharts is simple, it's easy, the charts look great. So if you're interested, click the link in the show notes to start your Ycharts free trial and see how Ycharts is a one-stop shop for growing your business with few hours spent.
You might push back on one piece of that, and then I want to hop into the thing we're talking about. And this actually will transition well because the company we're going to talk about has a lot of Miami assets. But a lot of what you're describing is going to market, and it sounds to me like going to market and feeling like this is Class A pristine market, right? You mentioned young people have a dating pool. One of the problems you had with Crystal City is it felt like John McCain was still kind of in control. And I absolutely hear that. Like, that's great for the long-term trends, the demographics, and everything. But you can have a pristine real estate property or make a lot of money in real estate, going and buying in the worst neighborhood and sprucing it up. Or a lot of I think we did a podcast on Howard Hughes, which is spun off Seaport. I've got a little position in both. I think those are kind of interesting, just with lots of different dynamics. But one of the things they always said with Howard Hughes was they were trying to follow the Donald Breen model of, hey, Irvine, California, we just built it over 50 years and had that vision. Or, there were plenty of people who bought right outside of Nashville, and then Nashville really gentrified and got better. And then all of a sudden they've got the best return of their life. So I understand what you're saying there, but what about when you're visiting a place that, maybe isn't that pristine, but the prices are so low, or you're trying to see the ball 3 years from now, or, hey, right now, maybe it's not great, but in 3 years, this is where the activity is going to be or something.
No, I mean, I think that is definitely a factor in our analysis, right? And this is why we like spending time on when we put boots on the ground, what we definitely want to do is, okay, how would you grade this location today? All right. And then is there a very obvious trend of developments or gentrification, whatever you want to call it, that are trending in your direction? Are you in the path, or are you like on the opposite side of that? Right. Because that could happen as well. Like you could have a great asset, great location, but because of crime or whatever the trend may be, people are leaving, and you're actually like on the other side, the negative side of the trend, and so we definitely pay a ton of attention. Like putting boots on the ground is about forming a strong opinion on where it is today, and then also like being able to spot the trend that, hey, 5 years from now, this could look very, very different. So going back to JB Smith, I think that 4 or 5 years ago, it was too John McCain. I think today it is kind of like we're starting to see some promises there, right? It's not there. It's nothing like Jersey City or Brooklyn, But like we're starting to see little signs of it, right? And hopefully we go back there 2-3 years later and it's super vibey, right? But these things take time. But sometimes you kind of see the transformation, and we've seen it with like FRP being on the waterfront in DC, and that whole area. That 15-20 years ago, that was all just industrial backwaters. The joke was people buried their bodies like down there, right? And now you can charge $3,000 for a 2-bedroom apartment there. So yeah.
Let's look, that was great. Thank you for walking through that. Let's use, and people can forget the last 30 seconds of that and go back to what we were talking about with Miami, because that'll be great. Let's go to the company that is actually the reason we want to talk about today. The company's AIMCO. The ticker there is AIV. You published a deck back in May. I think you're going to make it public so we can include a link to in the show notes so people can kind of see what we're talking about, really see very detailed. I mean, the deck is, I'm looking at 38 pages, and it's got pictures of basically every asset they own and everything. But why don't you just go like AIMCO? Why is it so interesting? I'm calling it AIMCO. It's Apartment Investment and Management Co. But yeah. What is it and why is it so interesting right now?
So AIMCO is super interesting because you could still buy shares today at, I believe, right now it's about $8.70. And $8.71 as we talk right now. And in our model, we believe that, the base case, it's worth $13.67. And we have a range between $12 to $15.16, right? Now, what makes it super interesting is that, one, there is a near-term catalyst. The company have come out and publicly said that they are selling three assets in Miami. Now, mind you, today the market cap is call it like $1.3 billion, but they're publicly marketing the development site next to Ken Griffin Citadel's future Miami headquarters for Citadel, which is literally like a stone throw away from there. And there was a Real Deal article recently that says that there were over 10 bids ranging from $500 million to over $600 million for that asset. It was like it's super interesting because like you texted me and then I'm like, yeah, I saw that. And it's hitting. It's this like article that was like kind of gibberish, but then like hidden like all the way down. And the article was this like super interesting, like that there's more than 10 bidders who's come in with bids ranging from over $500 million to over $600 million, right? So if you take that for this development site, which is highest and best use would be think like luxury high-end waterfront Miami condo with water view right on the water there in Brickell, Miami, like near all the new finance hubs and tech hubs in Miami. So that could be sold for anywhere from low end $500 million to call it like $650 million. Our base case is $590 million. And I think, we're kind of like on par with what that RealPage article did. And then they're also selling another recently developed asset called the Hamilton, which is a kind of an awesome trophy asset that was recently repositioned. It kind of looked like an apartment from Miami Vice. And we've been inside. We took a tour of it. So we've taken a tour of all three assets that are being sold. And, the development side is really, that's land value, that's future value, that's really on what a developer think they could reposition that as over 3 million square foot of future condos, right? Super high end, super, waterfront. And then the Hamilton is probably a $240 million asset. Also right on the water and just recently renovated with some incredible amenities. And we've been inside. We've taken tours of all three of them, and we felt really, really comfortable that, So we have a price point on the development parcel somewhere in that, over $600 million. We're using a $590 million base case. The Hamilton is 240. So if I'm doing my math right, that's $830 million of gross proceeds on a market cap that's called like $1.3 billion. And the company has specifically came out and said that they will, use the proceeds to return it to shareholders. And if you understand REIT rules, there's going to be some, gains on it where they have to pay you a special dividend. So, initially we got involved at 700, we call it like the mid sevens, call it like 750, 760. It's 870. Like at today's price, there's a scenario where you get somewhere between like, something in the 25 to 45% of your purchase price in special dividends, like if they close all those sales this year, right? So this is what makes it like super interesting. Like every time like I talk to someone, I'm like, this is a great sum part story. Everyone's like, well, what's a catalyst? It's like literally like this catalyst could happen it could happen next week, right? Could happen. It's Friday. It could happen on Monday. It could happen. And I think, they started the process in February. I'm sure like a process like this takes a long time, right? But like this could literally happen in days or weeks, but like, I would say that by the end of this year, you definitely like will know one way or another, right? So we're talking like mere month of like having some sort of like conclusion on whether like this gets sold or not, right? And then so that's a really awesome catalyst in the near term. Now, another thing that I did is Andrew always like pound table. He's like, Bill, why are they not buying back shares, right? And there's like we did we basically gave the company a report card, right, on page 11 of this.
I really like this report card. Yep.
Okay. And we're literally looking at, we're like, okay, like how did they execute it? How did they allocate capital? So like I'll go through some of this, right? In Q2 of 2022.
Before we get to the report card, because I love it. You're super passionate about it, and I asked what they did, and you jumped into the catalyst, the report card, and everything. Before we get there, I do want to go through all that, the review, everything. I try to start this every company pod off with this question now. Look, the market is a competitive place, right? And I love everything you're pitching, the catalyst, the sales and everything. But I will say, like, if I'm texting you Real Deal articles on, hey, this is their property, they're selling it, like that's very visible news, right?
Yes.
So I just want to ask, like, the market's a competitive place. What are you seeing that you think the market is missing that kind of generates an alpha opportunity right here?
Okay, so I think this is kind of our bread and butter. Our bread and butter is like these complex situation where you really got to roll up your sleeve, right? So our underwriting took us like a month or two, right? And that includes like putting boots on the ground. So if you think about like this is a collection of asset where there's over $100 million of net operating income on this like stabilized collection of multifamily assets, right? And then they have $521 million of construction progress, which is like not throwing off any cash flow, right? So you kind of can't screen for it. It's on the balance sheet, right, at book value, and we're valuing it at 1x book value. I'll talk about that in a little bit. And then you got some like unconsolidated that doesn't show up on the balance sheet either. Like if you're doing a NAV, a net asset build out, this kind of one requires very, very specific real estate knowledge. Two, like you can't just slap a cap rate on it. Like you really got to like roll up your sleeve and like do all the work and kind of form an opinion on like what some of those parcels are worth, right? Like here's a great example. That development parcel, right? If it gets sold at like call it over $600 million, you're in essence like the buyer is paying like a 3% cap rate on that, like for a office and a multifamily that are both going to be knocked out. Like in what world, Andrew, was someone like if I told you, they're gonna a certain public REIT is gonna sell an office and a multifamily at a 3% cap rate, like everyone will probably like laugh at me, right? But like what you don't know, and until you put boots on the ground, like you're like, Citadel is going to build their 1 million+ square foot like global headquarters. Not they got a headquarters in New York that they're building as well, but like this is the Citadel global headquarters where like I looked at the starting comps for their analysts and I got a little depressed because I'm
sure people felt that way 10 or 15 years ago, but I started my career at McKinsey and I look at the McKinsey salaries now and I'm like, damn, that would have gone a lot farther now than it was then. I've even inflation adjusted and been like, a good deal more now.
And so like I think, and also like they own development parcels, right? Like I'm looking at this NAB build out. There's just like $50 million here, $40 million there, like, $30 million there.
Another overarching question, right?
Yeah.
So one of your arguments, it sounds like to me, is, and we'll get into management and everything in a second, but one of your arguments is like, this is a billion-ish plus company, if I've got my kind of math right, but it's not the biggest of companies. It is really complex, right? And you're saying, hey, it requires specialized knowledge and a lot of time to underwrite this. And there are a few others that are like this. Like I think Bill Ackman with Howard Hughes, and again, we mentioned it earlier, but he would probably argue something similar, right? Howard Hughes is $3 billion. If you want to underwrite that and you want to visit all their properties, cool. You're going to have to do like 18 plane trips around the country. Like the accounting's complex. There's a lot of different assets. There are several others that we can mention in this kind of sub $5 billion, really complex, JVs. And do you think this is an enduring kind of area of alpha for real estate-ish investors where they've got these complicated pieces that are just really difficult and take a lot of time to value? Or is this more one-off and look, it's complicated, but again, the market is a competitive place. There are people willing to underwrite this, and you can go on Value Investors and get like 90% of the way there if there's a good opportunity, somebody write it up. Just wanted to throw that thought out at you.
I think that is this an enduring? There was like a time period in my career where I was concerned about like, highlighting these. And then what I find over time is that a lot of investors just don't have the patience for a lot of these situations. And sometimes like without a catalyst, like nothing gets unlocked right now. I pitch a couple on this on podcasts before, like FRP. I think you either, when you get involved in these, you really need to underwrite management quality and their incentives, right? So in the case of like FRP and the Bakers, like I just full-heartedly trust that family who runs it. They're gonna do a good job reinvesting that capital, and I know I'm buying it. I'm buying some of the best, highest quality assets there, right? Here in AIMCO, that's why, I was like so eager to get to the report card on page 11 because. Well,
let's go there. That's a great segment. Let's go to the report card because I really liked it, and I think it's really interesting. Yeah.
So the report card, like, I don't think I've ever seen a situation where I'm like, okay, like, what have they done? Like, how have they allocated capital? Right? They bought back, and this report card is like as of year end 2023 because at the time when we created, like they haven't reported Q1 yet. So they've consistently bought back on an annualized basis between 4 to 6% of the shares outstanding. And if you look at the math, and they bought back shares in 2022 at an average of $7.33. In the 9 month in 2023 was $7.51. Year to date in 2024, they bought back on average, just around $8, right? And we've told them at the NAREIT meeting, hey, just simply because your stock price has gone up doesn't mean it's not undervalued because of your development, because of your growth in rent, because of your share buyback, your NAV per share is actually higher now. So don't be afraid to keep buying back shares, right? Because those share buybacks could like in a couple years, like that could be very, very meaningful, right? So share buyback, huge. Like that's a question that you always ask, and I'm like, Andrew, like this, they're already doing it, right? And this is
me too. Yeah. Well, let me give a little. I love that you knew that's where I would go. Yeah. Let me give a little pushback, not a firm pushback, but I saw Land and Building was involved for a long time here, and they published, as I was researching it, they published a few letters that were pretty harsh to the board, talking about capital allocation, corporate governance, and there. Yeah. And I think a real skeptic, and I will caveat this by saying they've continued to buy back shares since Land and Building sold out, but a real skeptic would say, hey, Bill, they were buying back shares to get an activist off their back. And, while they might have been playing good while kind of the cops were out and watching them, now that the cops are gone, get ready for some shenanigans. And I just love to hear how you respond to that. Sure. And we can also talk about everything else they've done in capital allocation.
So we have a pretty good sense of like who the shareholder base is in this company. And then you could kind of go pull it up. And I don't think Land and Building is in this name right now. But there's a 13D filer from Texas. There's another activist fund. Like we know like a lot of the big players. Like and we have a pretty good sense that a lot of conversations kind of goes like this, right? Like, do not put a big check into a new development deal, close a discount. And we met with the management team at NAREIT, and that was kind of like we had a very cordial conversation, and we communicated to them that, hey, like at the time, the buyback in Q1 was kind of low. So I asked them, I'm like, you were doing a really good job with share buyback. Like, why did you buy so little in Q1? And they kind of explained that there was some blackout periods that really prevented it from buying back. There was like nothing changed. So from our conversation, it is very apparent to me that they understand that they have to close this discount, right? Mm-hmm. And closing this discount, whether it is selling off these non-core assets, because this development, this office that has a tremendous amount of value, this company should not develop that, right? They should have put $1 billion of equity into that development project to build, high-end condos. They understand that these non-core assets should be sold and the capital should be returned to shareholders. And if you look at their public press releases, they very much with a preference to returning capital to shareholders, right? So this is one of those really, now, how did they get there? I think, like Land and Building has been very, very public with their battle, right? There, and then there's another, third, Westdale in, I believe I'm saying that name correctly. Westdale in Texas filed 13D, right? And then, these other, like Irenic is a shareholder with like 2 or 3% of the shares. Former Elliott, managers, very, very smart, very sharp guys. So I think this company has a shareholder.
Ironic right now, they've run a few campaigns. They almost cannot miss. It's been incredible. If you were just fondly following Ironic, that's obviously not financial advice, and I know them a little bit. But if you were just following Ironic, they are on a real heater right now.
Yeah. No, they're great guys. I love both Adam and Andy over there, and so. I think that it is very obvious that the shareholder base wants this sum of the part, this NAV discount to close, capital return to shareholders, and I think the management team very much understand what they need to do.
One more on the management team. It is an interesting dichotomy because management owns a decent bit of stock. This is not Facebook, where Zuckerberg owns 20 or 25%, but they own enough to consider generational wealth, I would say. Mm-hmm. At the same time, they're also quite highly paid, right? Mm-hmm. So, one thing I was kind of flipping through the proxy when I prepped, and they got a short-term incentive award, and I was just looking of the triggers, I would say, a short-term incentive award, it says trigger 1 is 20%, and then here's goal 2, another 20%. Of the triggers, when I was kind of looking at it, I would say maybe 1 of the 5 were things where I'd be like, oh, that will actually drive shareholder value. So I just want to ask, when you look at this management team, I'm of two minds, right? On the one hand, decent share ownership. I think they've done a nice job over the past year on capital allocation and everything. On the other hand, the Land and Building letters probably do stick in my head a little bit. And I look at this and I'm like, hey, 30% of your KPI is development and redevelopment. That sounds good, but that's pretty tough to measure over 12 months. And I don't hear anything about return on that, or 20% is balance sheet. Every time I hear balance sheet, you know what I hear? I hear we're going to raise some capital, right? So I'd love to get your thoughts on that.
Yeah, no, I mean, I think that I am very confident if this management team, try to raise some capital, especially on equity, this house will probably, I mean, there's some really angry shareholders going to come out of the woodworks, that I'm very, very confident about, right? And I would say don't anchor yourself too much to Land and Building. I think that I want to give Land and Building credit for their involvement. I think their involvement has really improved the corporate governance of this company. There's things that's done, they declassify the board, they opt out of the Maryland Unsolicited Takeover Act, right? Because a lot of REITs have this, where you can't, right? So they opt out of MUTA. I think the corporate governance of this company is way better today, after all that. Now, to be totally candid, I wasn't around. I wasn't a shareholder 3-4 years ago when all this was happening. I was kind of peripherally aware of what was going on, but I wasn't in the weeds, right? So I would say I wouldn't anchor yourself too much to what land and building like you know what they say, like they say, you know, don't pay attention to what Buffett says, pay attention to what Buffett does. And I'm paying attention to what they do, and what they do, their actions are continues to reflect that, hey, like there's great capital allocation here. There's great, like, there's clearly an understanding that they need to unlock that discount and return value to shareholders. And you know, to add one more, you know, we spoke with them a couple days ago, and there's like very clear understanding that they're not just going to plow $200-300 million of equity into development projects, because they do have a very large pipeline of land that they assemble over time in Fort Lauderdale, in Miami, and in Colorado, where they could build thousands of units of multifamily, where, you know, they could start the development on them. And really, right now, they publicly come out and said that really, like, if they were going to do one, it's going to be the Hamilton House, which is waterfront in Miami, right next to the Hamilton building, right? So there's clearly like a very there's a very clear understanding of like what the objectives here are, and we're going to be off that view until, you know, we see something different.
Perfect. Just again, I'm going to remind people, if you want to see, Bill's got a 38 slide deck that he's going to make public. We'll have a link to it in the show notes. So if you want to follow along what we're talking about, dive into any of the different things here. Bill, we were kind of wrapping up on the report card you gave them on, this is slide 11 of the deck for those following along. But anything else on the report card of capital allocation that you want to discuss, or should we start hitting a couple of the different individual assets?
I think that, let me see. You know, I think another thing is like, so I'll quickly go through the report card. Like, if you look at like what they did in Q2 of 2022, they locked in debt with 9.1 year term with a 4.25. Like what a trade, right? Like, what a trade to like, and also.
And anytime you've got debt outstanding and you could take that cash, and obviously this is in the future, but you could take that cash right now and put it in a money market fund and get more interest income than you're paying on this 9-year debt. Like, oh, what a trade.
Yeah. And like, and they did that just before. And so also, like, understand that what makes that debt super interesting. I don't know. I forgot what the total balance on that is like $700 or $800 million in total. That is assumable in a sale. So like, and they call that out as an asset, right? Because like the discounted cash flow, the net present value of that, you know, lock-in assumable debt has tremendous value, right? And that's how you see some deals get done at high force cap rate in the last couple of years, because it came with assumable debt where you lock into like very low interest rates, right?
So 100%. Is this kind of unique though? Because a lot of those that I've seen have been, you know, we've got a mortgage, a property level mortgage at 4%, and that can go transfer to any buyer. But I haven't seen too many of kind of the holdco, where the holdco, and this applies both to real estate and non-real estate, where the holdco has transferable debt. There are one or two special situations I'm aware of that have it, but it's pretty rare, especially with notes. So do you think that was? And the reason I kind of ask is, look, if they did this and they got this is a unique term, they got this unique term, that kind of suggests they might be setting themselves up more for a sale than maybe a punter like me thinks.
Yeah, I mean, you know, that was something that we talked about specifically at NAREIT. Like, you know, we were talking to them about that, and they like pointed out, hey, that's actually assumable in a transaction. And we're like, okay, like that was something that we wasn't aware of. Like, I mean, I just think it's interesting, like, you know, as we were going back and forth, like, are they going to do the right thing? And then in our meeting, they like volunteer that information, you know, like behaviorally, right? Like a lot of this business, a lot of this investing craft is like understanding like the behavioral aspect of an investment. And to have a management team to be like so open to like and volunteer a lot of that information and really like showing their hands that, hey, I think what's going to happen is the non-core one-off assets, like your this waterfront development, that kind of gets like sold. But like you can make an argument that as a lot of these other assets stabilize, because there's there's over $500 million of construction in progress, which they've said that it is the rent are, I think, on average 17% above what they underwrote to, which is a really nice kicker. I think as those stabilize, now you have a portfolio that are largely cash flowing, stabilized, and I think that portfolio could be sold as a portfolio deal, right? There's some of this development parcel, maybe like what it makes sense is for like the management team to take that take private, like sell everything else, and then I think Wes, the CEO, is a pretty good developer based on their projects that they're completing. I'm like, someone else like that probably the development process should probably be in like a private vehicle, right? So like I could kind of see ahead that there's like certain pieces, like some of the chess pieces, like fit, like this one fits here, that one fits there, and so kind of I'm just really excited, and there's like some horse trading that they've done with some of the development parcel. Like they bought a development parcel down in joint venture with Kushner's in Fort Lauderdale. They bought 3 parcels for $49 million, and they sold 2 out of the 3. They kept the third one, which is like the biggest one, which is about half of the they got all their cost basis back, right? And now they got like this development parcel that they got for free, and you can build hundreds of units on it, like that. There's just like it's like you're like, we're grading this management team, we're grading their capital allocation, and it seems like they're buying back shares. They're doing a good job with like locking in fixed rate debt. They're doing a good job with like some of the horse trading with like some of those parcels. And it seems like all the developments are doing really well. And if anything, from a valuation perspective, we're using 1.1 times book value for the development. And if you kind of do the typical multifamily development math, you usually try to develop to a 6% cap rate, unlevered yield. Market used to be 4.25%, 4.5% for like a brand new stabilized. But like if rent is 17% above your underwriting for 6%, like they're probably closer to like a 7.5 cap rate, right? Like even in like a elevated cap rate, like there's probably a lot of value creation in that development pipeline that we're not baking into this NAV number, that like we're using conservative 1 times book value. So I think there's like a lot to be excited about. I guess like we're kind of doing everything in reverse. Like we could probably go through some of the big buckets of value.
The only issue is again, some of the stuff I've had you on my mind, and I knew this podcast was coming up. Some of the stuff I wanted to talk to you about, like the boots on the ground and everything. So I feel, but I am going to have to hop in a second because we're running well over an hour already. But maybe we could just like 1 or 2. We've already talked pretty nicely about the Miami assets. Maybe 1 or 2 other assets you specifically want to call out and focus on that you think. Again, we'll include a link to the deck in the show notes, but investors might really want to be thinking about, or where you think the market's kind of underestimating the value or something like that.
Yeah, I mean, let me just like I'll do so there's 1.6 billion dollars of multifamily assets that are totally stabilized. It's over $100 million of net operating income. And we, value them anywhere between 5.5% to 6.5% cap rate. Now, going back to what we said about recent transaction comps. Now, some of these are kind of like older assets, so the older vintage assets, right? So they deserve to trade at a higher cap rate. I'm just saying that generally, if you're like valuing assets outside of Boston where they're sitting on like very large parcel of land and you can't really build in those markets, and there are some of the more affordable units, housing units in those markets in like really nice neighborhoods, like to put a 6.5% cap rate on it, like that's probably not like, we're probably being conservative there, right? We're probably being conservative there. So so that's $1 billion, that's the easiest part to value, right? And people could use their own cap rate assumption there. So you could kind of think like, especially as rates drop, if they do, like there's probably room for cap rate compression there to like, and cap rate compression, cap rate expansion, in the 5-6, like every 50 bips, like every quarter, every quarter percent, like is a really big deal, right? So
yeah, no.
So I kind of want to point that out. And another one is just kind of keep going back to that development pipeline. There's $528 million of value. We're carrying that one-time book value. I would not be surprised if when they kind of stabilize at different times, some of it like maybe two years out. I would not be surprised if that that $528 million, that could be worth $700 million or $750 million, right? So there's because we're carrying at like cost right now, and based on the higher rent than expected, like naturally you're developing to 6 caps that are like that could be $750 million, like when it gets fully stabilized and gets sold, right? So I think those two are like the we talk about the Miami, we talk about the development sale. Those are probably the two biggest buckets where people may want to apply their own cap rate, their own like book value multiple, and then I kind of want to bring the conversation back to there's like other like development parcels, like scraggler assets, like they got some investments in this like real estate tech fund, like those are smaller line items, right? If you take the development. The current construction on the progress, this condo development site, and then the stabilized assets, like those are 3 big buckets. Now, one thing I want to highlight is one reason why at one point this is still like one of our top 3 positions. Right, at one point I think it was officially our largest position, and then we recently found something that may be like even more event-driven than this, right? So, but one thing to think about is that. If we get into an environment where they keep buying back shares and interest rate fall, you could kind of get a little bit of a Lollapalooza effect where all the share buyback that they're doing, because like if you take the cap rate assumptions like down by 50, 100 bips, like across the board, all of a sudden, like you could have a net asset value where in the base case, we're in like the mid $13 range. Like you could start like getting them into the high teens, and that's what makes this really interesting.
I do hear you, and that's the beauty of buying back shares under NAV. Though I would just point out, like you're saying the Lollapalooza effect, but that's like a Lollapalooza effect where you buy shares back at a discount and the macro really goes in your favor. Because you could also counter it by saying, hey, if they buy back all their shares, but the 10-year goes to 27, well, then they bought back shares at 8.
And Andrew, I will take the other side of the trade of the 10-year going to 27, right?
No, I'm just because I do hear you, but I think the most important point, just to me, the most important logical point is NAV is 1350. They're buying back shares at 8. And yes, you would get an upside on that side, but that's kind of betting on. Though, as you and I are talking, like one of the things that's happened is interest rates have come down a lot, and I think when you look at it, the market has started responding to it in some of these real estate stocks. But I would probably say, hey, the 10-year was at 480, it's at 380, whatever it is right now. Like a lot of these stocks that are up 10 or 15%, if you really round the numbers, they should be up 30%. Now, the counter would be, hey, in 2021, when the 10-year was 2%, none of them were pricing in the 10-year at 2%.
This episode is sponsored by our friends at Ycharts. With all the various job functions that advisors are tasked with, your time is extremely valuable and often scarce. Ycharts is a platform centered around efficiency and built with speed in mind. With an intuitive and user-friendly interface, Ycharts helps save advisors 29 hours per month while uncovering better and new investment ideas. Need a way to help clients visualize their financial future, reinforce the importance of consistent investing, and guide them towards informed decision? Ycharts has tools for scenario building, portfolio construction, and proposal generation that can be the missing piece to your service, so you can act on an idea right when the light bulb clicks on. Again, I mentioned this last week, but there's a reason almost every post I do at the start of most of these at the start of most of these podcasts, if you watch on YouTube, there's a reason I use Ycharts graphs for them. And it's because they're really simple, they're really easy, and they look great. I can't spend, if I'm using some other service, I can't spend 30 minutes, an hour and a half trying to get 4 different charts ready for a post, right? Like that would take almost as much time as the post of the podcast I'm actually taping. Ycharts is simple, it's easy, the charts look great. So If you're interested, click the link in the show notes to start your Ycharts free trial and see how Ycharts is a one-stop shop for growing your business with few hours spent.
Yeah. You know, the last, I'll give you the last word. The only thing I wanted to add to your due diligence is bank lofts in Denver, which they own. I remember it well because it is like inside of a mecca of escape rooms. I don't know if you know this. Throw that into your numbers. There are 5 escape rooms all around there, and I haven't been to Denver in several years, but as of 2019, I owned the room record for 2 of the escape rooms, and there's like 5 different escape room companies around there. So it is a mecca for escape room. I want you to put that into your numbers, all of that. Bill, just any last thoughts you want to hit before we wrap this up?
I think the last thought would be like going back to like, you know, the sale of the Miami development, right? Like there's the buyback, and then like don't forget like this kind of could potentially get into like Buffett style, like early Buffett partnership style, where you could be getting special dividends that are somewhere between like 25 to 40%. Like you really dramatically reduce your cost basis, right? I mean, there's a reason
at the beginning, REIT rules, if they have a gain on these sales, they have to pay the gain out. And you know, sometimes people will try to dodge that by paying the gain out in shares or something, but I think they paid out in cash. And as you said, you $8, you get $3 back, and then the stock is well, the IRA looks really good.
Yeah, and so I, like, you know, there's like a second leg. Like if they do pay that special dividend, like there is a second leg where we'll look at what the valuation is, what the leverage ratio is. And like that may give us another opportunity to like take that special dividend and just be like, now we own more of something that's, you know, even more undervalued, right?
And you know what else? It'll give us a second opportunity to have a second podcast on this.
Yeah. I mean, like, you know, there was one. You would love this story, Andrew. I know we're running over, but I'd love to tell the story. Like 10 years ago, I did a trade where Enzyme was spinning off Care Trust. And in like that was like when you know propcos could spin off opco, you know, opcos could spin off propcos.
The glory days.
The glory days. And then they like I think Adam Whiteham's dad actually like put in a new regulation that outlawed that, right? So I'm like forever mad at him for that. And then so what happened was that the special dividend, because they have to purge all the previous profits and earnings, right? So they have to like pay this special 50% dividend. And you like only 20% was going to be cash, you know, 80% was going to be stock, right? And you could elect to get cash or stock, and like it defaulted. But like long story short, at that time I knew that the stock was severely undervalued. So we elected to take 100% stock, right? And that stock, when we got those stock dividends, it was basically by default a massive share buyback on something that was like already super undervalued, right? And I mean that was and we could like potentially you know get like another bite of the you know that's why we have a detailed model, like, you know, we're watching out for that. I mean, there is a part of me who's like, man, I kind of wish like I don't talk about this, because then they'll just keep buying back shares and keep buying back shares at 870, like lower the price they buy back. But I think at a certain point, like you do need the discount to close, right? So maybe by talking about the stock price is higher and the buyback is like not as accretive, right? So it's a perpetual value investor struggle, right?
It is, you know, and you know it's a struggle, but it's always nice. And also, you know, I do think putting information out there begets information. Like, okay, let's in a hypothetical world say you talk about one and that goes to fair value. A, you get the nice returns, but B, I think putting the information out there, you know, I certainly have it happen all the time where someone say, hey, Andrew, you were really into this investment. Doesn't this kind of rhyme? And I'll be like, oh my God, not only this rhymes, it's like 10 times better, or, you know, start a new conversation. So Bill, I might have an angry wife if I let this podcast go any longer, but I have really enjoyed this. Your 5-timer shirt, if it's not already in the mail, will be in the mail soon. Looking forward to having you on the 6th time, and looking forward, I think we're going to be seeing each other in person in the near future. So looking forward to that. But Bill Chen will include a link to the presentation in the show notes, and looking forward to it, bud.
Okay, awesome.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.